down this tree today. This tree is 18 to 20 inches in diameter and 35, 40 feet tall. So it is also has a really nasty lean to it. Let's go over here where you can kind of get a good idea of what the lean looks like on this tree. So if we were to just cut that tree down right now, it would demolish the trampoline as well as take out a number of these other trees over here that I am not in any kind of desire to have knocked down. I'm going to start by going up there, throw a rope over, so I'm going to have to climb it with a rope, which isn't the best thing, but I don't do this for a living. I do this on the weekends for fun, and I happen to have a harness with ropes, and I do not have a flip line with spikes. So that's how I'm going to do it. Let's get started. How many chances is this going to take? We're now sitting up in the branches. I'm probably, 20 feet off the ground here, maybe 25. We're gonna start cutting branches, but before I did that, I thought we would take this moment to talk a little bit about the information system. So in the first lecture, what we talked about, or what we just talked about in the last session, was the accounting information system right up to where we were getting ready to finalize and prepare some reports for the financial statements. So we're gonna pick this same series up and basically take it from the trial balance, which is what we prepared right at the end of our last thing. We're going to take our trial balance, we're going to go through preparing the financial statements from the trial balance, go through adjusting entries, closing entries, and then wrapping everything up and getting ready for the next period. So that is where we're going to go. So briefly, walking through the accounting cycle again, we have events that happen. Again, there's lots of events. They aren't all accounting events. Some of them are. So if it's accounting, if it's something we track in accounting, it's an accounting transaction. We record that transaction in the journal. The individual accounts impacted by transactions end up being posted to ledgers, which is a summary of all the activity within a specific account. At the end of a period, then we take all of those accounts and we put them all together in a trial balance. And that's just a list of all of the accounts and their balances, debit or credit. So that's where we left off, was we had a trial balance. And now we are going to take that trial balance and do some adjusting entries. I talked briefly about the difference between internal and external events and transactions last time we talked. I'm going to expand on that a little bit. So adjusting entries. An adjusting entry is recording an internal transaction. That means nothing happened outside the business that would dictate accounting treatment. However, things happen within the business. Usually we use up resources, or we create resources in some case, we create, or there's an increase in, say, claims on those resources, so increase in liabilities or a change in our equity. Somehow something internal to the business changes that we need to account for and make sure that gets reflected in the financial statements. So we do that through adjusting entries. So adjusting entries, they ensure that the balance sheet and the income statement are appropriate. Basically, the assets and liabilities are appropriately recorded ahead of the preparation of the financial statements, because we want the financial statements to accurately reflect the value created or destroyed as part of the business during that period. So to do that, we need to account for both external and internal events, and whether we use up resources by expending cash or we use up resources by just depleting them. For instance, using a vehicle is gradually using up that resource. Well, that's internal, that needs to be accounted for. We call that depreciation. So that's real quick. A couple of types of adjusting entries. So basically, you can break all adjusting entries down into two different things. We have deferrals and we have accruals. Deferrals, the cash comes before accounting gets to recognize it. So there's some kind of a transaction with cash that occurred, but accounting doesn't recognize that as a change in the value. So it does not recognize that as a change on the income statement. So that's what recognition is, recognized on the income statement or through the income statement. So a deferral, cash occurs first before recognition. So some examples, we have prepaid expenses, where expenses are paid in cash before we actually consume the good. Think about utilities or rent or insurance, where we pay it a month or even up to a year ahead of time for, say, insurance, where we haven't utilized that service. So that is a prepaid. The cash came before we recognized the expense in the prepaid expense condition. Now on the revenue side, we have unearned revenue. That means we received cash came in before we get to recognize the revenue. So all those same places that we pay cash ahead of time before we recognize the expense, well, from their perspective, they're receiving cash before they provide the service. So for instance, insurance, they get a bunch of cash payments for insurance premiums, and then they earn them by providing that insurance over the course of, say, the next year. So some other examples, so warranties, where you buy a product, you pay for a warranty, and that warranty will last for, say, 5 years. That is, again, the cash is coming into that company before they have provided the service or the service obligation, as we talked about definition of revenues before. So warranties, service agreements, tuition, airline tickets, these are examples of unearned revenue, or we call it deferred revenue. They're the same thing. That is deferrals. So we have prepaid expenses and unearned revenue are deferrals where the cash precedes recognizing it on the income statement. On the other hand, we have accruals. Well, accruals, we actually recognize something before the cash changes hands. So we incur an expense or we earn revenue before we receive the cash for that. So any kind of invoiced sales, rent income, insurance income, those are all going to be accruals. So we have accrued revenue. Services are provided, but no cash has been received. So that's often the case, especially for invoiced sales. So accrued expenses are the other side of that. That means, again, we recognize the expense before we actually expend the cash. So anything we get billed for is an accrual. We typically have a bill, so it's called an account payable. We don't need an adjusting entry for that, because the bill is the event and the transaction we get to record. But utilities, any kind of billed services, those are accrued expenses. So they're things that we owe, but and have incurred, expenses we've incurred, but have not yet expended the cash. So those are accrued expenses. So again, two types of adjusting entries. There's deferrals and accruals. So walking through how that ends up looking. So let's take a prepaid expense example. These are pretty common. We'll take rent. So we're going to pay rent at the end of 1 month. It's actually for rent that we're going to be utilizing the facility the next month. So we have prepaid rent. We're going to say August 25th. We pay rent for September. So we're going to pay $600. So we have cash going out. That's a credit for $600. And then we have the prepaid rent amount, which is a debit to prepaid rent. That is an asset. We have not used the building yet. We haven't incurred the expense. So it's sitting as an asset. Now, when we actually use the building, it'll transfer from an asset. We'll use up that asset, and it'll come in through an expense. So that's the journal entry. The adjusting entry. So an adjusting entry on, let's say, in September, the adjusting entry in September is rent expense and prepaid rent. So we put it into prepaid rent in August when we paid the cash. Now it's September. Well, an adjusting entry would be actually recognizing that expense in rent for the period. We're going to expense rent, which is a debit, and we're going to get rid of or eliminate that resource. That asset that we had goes away, and we expense it. And that's our adjusting entry. Accruals. So now we have this on the accrual side. We just did deferrals. Now we're going to do accruals. So we have accrued interest, for instance. So accrued interest, we have incurred interest, but we have not yet paid it. So we have a loan outstanding. Let's say, well, maybe we pay only quarterly. So we have quarterly interest payments. Well, up until we make that payment, we're still incurring that interest. So we want to make sure that the interest becomes recognized as an expense as we incur it, regardless of whether we pay it in cash. So our adjusting entry, let's say we incurred $800 of interest in the month of August. So we're going to recognize that interest expense because we've used that revenue, used that cash or that loan for the month of August. That is going to be an expense, but then we haven't paid anything yet. So that is a liability. We owe someone that $800. So we're going to debit interest expense, credit interest payable. That is our adjusting entry. Now, when we actually go and pay that, let's say we paid it on September 5th, we're going to pay our interest. So then we would get rid of cash. So we credit cash for $800 because that is the reduction of a resource. We no longer have that cash. That goes away. And then our interest payable also goes away of $800. So interest payable goes away because we've now paid that claim. There's no longer a claim of $800 on our resources. We took our resources, we paid off that claim. So that is how that ends up working out. So that is our adjusting entries. Those are two examples of a deferral and an accrual in terms of what we need adjusting entries for. In general, the adjusting entries just make sure our balances are correct in terms of assets and liabilities, and then natural income statement comes out of that to make sure we're recognizing expenses when we actually need to, and we're recognizing revenue when we need to, and not putting it in the wrong period just because that's when the cash seemed to flow or that's when the transaction or event happened. So now we're going to prepare financial statements. So financial statements are prepared directly from the trial balance. So we have a trial balance that lists all of our accounts in generally account order, which is assets, liabilities, equity, usually in order of liquidity is typically how trial balances are organized. So we're going to use that. We're going to directly prepare our financial statements from that. So our financial statements, income statement, retained earnings statement, and a balance sheet. Those are what we're going to prepare. Typically, we summarize a group of accounts into one line item on there. In a lot of the examples that we run, we just have like say one receivables account or one cash account. But when you actually start working in practice and see anything other than an academic example, you're going to run into, okay, the company has whatever, 5 or 6 different cash accounts and an investment account that has some cash sitting in it, right? So all of those get lumped into cash. Same thing with types of assets. You might have 15 different types of equipment for internal purposes, but at the end of the day, for financial statements, you just say we just have a bunch of equipment. So all of the financial statements get prepared from the trial balance. Now we have an adjusted trial balance, so all the account amounts are correct. Now we just need to summarize those and put them into the financial statements themselves. So how is that done? So a quick example, we talked about, like, I started up my fishing company and I have my trial balance. It had cash of $12,000 and equipment of $4,000, a loan for $10,000, and we made sales and had no expenses. And our sales were $6,000. We had no expenses for this period, which probably isn't right, but I didn't make my adjustments. So this is what I've got for the time being. So I'm going to take my cash equipment and my loan. Those are balance sheet items. Those are going to go on the balance sheet. Those are real accounts. They never go away. We don't close them out at the end, which we'll talk about in a minute. So those are my real accounts. They end up on the balance sheet. I then have my retained earnings. So I'm setting up my retained earnings. This is my first period. It starts with a balance of 0. I have no earnings to have retained in the past, therefore I have no retained earnings. However, after this period, I will then have retained earnings because I made $6,000 selling fish. So my retained earnings goes to my retained earnings statement. The retained earnings statement, as we'll talk about later on, is just a roll forward of retained earnings. It says, what did I start with? What was my net income and dividends for the period? And then what did I end with? So in this case, it would be very easy. I started with nothing. I earned $6,000. Therefore, my retained earnings at the end of the period is $6,000. And then sales is my only income statement account for this period of time. And sales goes to my income statement. So that's my income statement. My net income is $6,000. I use my net income to feed my retained earnings statement. Moving on, now that we have generally how we've taken our trial balance and translated that into financial statements, we're going to prepare closing entries. Closing entries is where we take all of our nominal accounts and we make them 0. Nominal accounts, remember, all they're doing is measuring the details of what made retained earnings go up or down for the period in terms of operations typically, right? So they're just measuring it for the period. Once the period's over, we want those all 0 and start over again because we want the next period to measure the next period's changes, not last period's and this period's. So what we do is we take all those entries. They're really just equity, as I've talked about before. The income statement is really just a bunch of equity transactions that we break out individually. We take all of them and we basically 0 them out into retained earnings. So what does that end up looking like? So our sales account that had $6,000 of sales. Remember, sales is an increase to equity. It's a credit balance then. So sales of $6,000, well, we need to make that go away. So we're going to make that sales account go away. I close out my sales account into retained earnings. So I've debited sales, credited retained earnings, and then my post-closing trial balance, I end up with a post-closing trial balance that has only balances that are sitting in my real accounts. So cash, equipment, loans, and retained earnings in this case. Sales, there is no amount sitting in my sales account because I've zeroed it out. Now I'm ready to start recording sales next period. So this is one of the reasons, as when we get to it, I'll highlight this right now. This is one of the reasons when you prepare an income statement, the income statement is for the period ended, or for the, say, the year ended December 31st. Well, that's because it's a period of time. Whereas the balance sheet is as of. So the balance sheet is as of December 31st, is say a balance sheet date. So once that's all done, we've zeroed out all of our nominal accounts. We're sitting with just amounts in our real accounts. We're ready to start again. There are you can do what are called reversing entries. Now, reversing entries aren't always done, but occasionally they are. They make things easier. So they simplify future accounting. This is helpful, especially if you have systems and people who just make very similar entries over and over and over and over and over again. You don't want them to be confused because you made an adjustment to close out the last period to get your balance sheet or your assets and liabilities correct, and then they go and they record the same entry they record every week, and it messes everything up because they didn't realize part of it was sitting in prepaids or something like that. So those are called reversing entries. All it is reversing out the adjustment. The classic example of a reversing entry is payroll. So let's say you have someone who processes your payroll, and every week on Friday, they process payroll, which means they're going to debit say payroll or salaries expense, and they're going to credit cash. They make this entry every single week. Day in, day out, they make it. Now, you come along, the end of the period is midweek, so you have to accrue some of that payroll, i.e. you incurred wages expense, but you haven't paid them yet. So you need to record an adjusting entry. So you would debit salaries and wages expense and credit payroll payable or salaries payable or something, some liability. Okay. Now you close out, and the period has the right amount of payroll in it because you made that adjusting entry. And now at the end on Friday, the same person who processes payroll the same way is going to want to debit payroll expense, credit cash. Wait, but you already put half of the week's payroll expense into payroll expense. You don't want them to basically double up what your adjusting entry was. So what a reversing entry does is it takes your adjusting entry and just backs it out. It reverses it. So actually, when you start your recording, you actually have a negative payroll expense that then when that first Friday rolls around and your bookkeeper goes and records payroll expense, it does the amount that ends up, the balance that ends up in there is actually just the amount that should be because the adjustment, because you reversed out the adjustment into the new period, which gave you the right amount. So let's say you had $5,000 a week of payroll expense. You had made an adjusting entry for $3,000. If the data entry clerk then just recorded the payroll expense of $5,000 on Friday and put it into cash, you'd end up with payroll expense of say $8,000 that first week instead of $5,000. So your reversing entry, you're going to reverse out your adjusting entry. So payroll expense, instead of having $3,000, is going to have say negative $3,000 in it. Then when that payroll clerk records $5,000 payroll expense, it brings the balance of payroll expense up to $2,000, which is the correct amount for the 2 days in the new period of the financial statement. So that's reversing entries. Be aware of them. A lot of companies don't do them anymore. Or there's systems in place where when you make an adjusting entry, you can just indicate, hey, reverse this out, and the system automatically does it. But that's the general goal of reversing entries. So that kind of wraps it up. Our accounting cycle. We're finishing up the entire accounting cycle now. We'll be moving on in the next video. But basically, the accounting cycle, we go from events, they record accounting, treat some of those as transactions. We record those in the journal. They get posted to the account ledgers. We use the totals from the ledger at the end of the period to make a trial balance that lists all of the amounts, having taken into account journal and adjusting entries for the end of the period. We take our final adjusted trial balance. We create our financial statements with that. When that's all done, we close out our nominal accounts to retained earnings, and then we start the whole process again. So that pretty much wraps it up. Make sure that you are familiar with the types of adjusting entries, understanding how the financial statements get prepared, why we have adjusting entries, and how that process flows to create financial statements that are correct. Also, make sure you know which accounts need to get closed out at the end of the period to make sure that we're starting with a clean trial balance and clean accounts for the next period. Also, be familiar at least with what reversing entries are supposed to or try to accomplish. So with that, I'm going to start cutting some branches off and try to get this tree down. Have a great week or a great day, and God bless.